In today's real estate market, there's a lot of misinformation circulating, especially about the idea that now is the best time ever to buy a house. However, that's not entirely true. There have been many times in the past that would have been much better for buying a house than right now. Let's take a closer look. One of the misconceptions is about affordability. While interest rates have been dropping over the past few months, they have started to rise again recently. They are now closer to 7%. Whereas they were around 6.5% before. Despite this, real estate agents are pushing the idea that now is the best time to buy because of the lower rates. They may say, oh, it's not 8%, now it's 6.5%. But the difference isn't as significant as they make it seem. For example, they might say that someone with a $3,000 monthly mortgage budget can now afford a $453,000 home due to the lower interest rate. This is presented as a $40,000 increase in purchasing power compared to October, when the interest rate was 7.8%, and the same house would have cost $416,000. However, it's important to note that a $3,000 monthly mortgage payment already assumes a monthly income of around $10,000, which is not realistic for most people in the country. So, despite what you may hear, it's essential to consider all aspects of the current market before deciding on buying a home. It's important to note that the examples given often apply to those looking to buy houses that are outside the budget of most Americans. The average household income across the country is $75,000 a year. To afford a $450,000 house, you would need to make about $120,000 a year, which is way beyond the average salary and household income. While it's true that people can afford more than they could a few months ago, the reality is that this benefit mostly applies to the top 10% of earners in the country. For the majority of people, the increase in affordability is much smaller. Spending more than 30% of your monthly income on your house payment, whether you rent or own, is definitely unwise. While some may argue that this is just a guideline, it's important to be cautious about going above this threshold, as it can lead to financial strain. It's worth noting that the rent is often high because of the high demand for housing, not because people choose to spend more than 30% of their income on rent. According to the U.S. Census Bureau, 27.4% of homeowners are considered cost-burdened or house poor, meaning they spend more than 30% of their income on housing. This is proof of the misguided advice being given by financial experts who suggest that spending more than 30% of your income on housing is acceptable. This advice essentially encourages people to join the ranks of those who are already struggling to make ends meet. Living in expensive areas like New York, San Francisco, Los Angeles, or Miami often makes sticking to the 30% rule impossible for most people unless they are top earners. One of the reasons given for exceeding the 30% guideline is the idea that housing has both consumption and asset value. But a house is not an asset unless it generates income, such as through rental properties. Until you sell your house for a profit, it remains a liability. The notion of using home equity as a financial resource has led some to treat their homes like piggy banks, borrowing against them to finance lifestyles they can't afford. This practice further puts individuals in debt. Another common misconception is the idea that your house will be a future source of wealth. Many people believed this in the mid-2000s when purchasing homes, only to realize later that it wasn't true, unless they held on to the property until today. Another persistent myth is that you can always buy now and refinance later. However, this is not always true. If you buy a house today with a high interest rate and plan to refinance when rates drop, there's a risk that your home's value may not have increased enough by the time you want to refinance. Regarding the housing market, it's wise to wait. Recent data shows that home sales continue to decline, with an annualized rate of 3.78 million, down significantly from previous years. This trend suggests that only the very wealthy, who can afford to pay cash, are buying homes. For those waiting to buy, there's some good news. Inventory is slowly increasing. In December 2023, there were 4.9% more homes for sale than in December 2022. While this is a positive sign, we haven't seen a surge in inventory yet. However, there are many uncertainties in our current system. Mortgage rates, for example, have been quite volatile, swinging from around 8% in October to close to 6.2% recently, and now back to almost 7%. These drastic changes are unusual and could be a sign of instability in the market. Despite market expectations, the Federal Reserve has not lowered interest rates, leading to the recent increase in mortgage rates. This shows that the market may have been too optimistic about rate cuts. Despite the fluctuating mortgage rates, there hasn't been a rush of people buying homes. Mortgage applications were actually declining during most of this period. Perhaps people either didn't believe the hype or simply couldn't afford to take on more debt. This brings us to a critical point. The current market is incredibly volatile. Interest rates, stock market trends, and even job numbers have been unpredictable. The market's future is uncertain. Despite expectations, we've been consistently surprised by the outcomes. What are your thoughts? Let us know in the comments below. Keep subscribed to our channel for more.